And welcome back, folks. The Ray program. Ray Lucia here, 844-RAY Show. In particular, if you have a question for Gene Pastula, certified financial planner, good guy. And we're talking about post-retirement health care and health care expenses. Gene, welcome to the program.
Thank you.
I was reading your Pearls from Pastula just the other day, and all the wisdom that you share with advisors all around the country, and I thought it was quite compelling. I don't know if you had an opportunity to listen to my first segment as I discussed this whole issue of post-retirement health care. It really is the number 2 expense that retirees face after housing. You've come up with certain solutions for that, but people have to be willing and disciplined to actually take action.
Actually, they have to quit denying that it's going to be a problem for them. I have an associate who said that the average, particularly men, the average man's consideration of a long-term care issue is about 30 seconds of denial. So,
yeah.
So that's real. It's a tough one, you know.
It is a tough one, and I can understand why. Nobody wants to think about that stuff. And it comes from a long line of, 20, 30, 40 years ago, people just died on schedule or died before schedule. But now what we're finding is people are indeed living a lot longer. And if you don't manage that risk, it's a good way to deplete your entire portfolio, leave your kids nothing.
The most enthusiastic people for planning this that we talk to are individuals who've just finished taking care of their aged parents, and now they're in their late 50s or early 60s. And not only do they see the expense involved, but the emotional toll that it takes on everybody in the family and the kids. And sometimes you have, the children fighting over, what to do because of the money and involved and all the rest. And if there's a plan in place with some sort of financial strategy, it certainly makes life a lot easier for everybody concerned.
No, and that's what you do. You create plans for individuals, and this is what your passion and career has been for as long as I've known you, which is a pretty long time. And one of the things that you do is you create a financial plan for long-term health care. Do you put those plans in writing for people?
Well, in writings, no, not really. I mean, I haven't. Basically, the idea is that what we're looking for is a part of their financial plan that clearly is going to provide extra money should they have to pay for care. First of all, you decide whether or not, you start to understand that, no, my kids shouldn't take care of me. That's not fair to them, and it's not something that they do well. Taking care of someone in a convalescence type of situation is best left to people who know what they're doing and are strong, because you're lifting people, and and it's something that you don't want your daughter doing for you.
Well, the other thing that I've found is, you have kids, and many of them are all around the country, and the one that's closest takes care of mom, and the other 3 are going, phew, got out of that one.
That's
old Sally over there, yeah, she's a trooper. And then when mom passes on, it's like, yeah, let's divvy up the money real quick. And I didn't work for it, and Sally did.
But I want my share.
But I want my share, right?
That type of thing. Sure. So that's an issue that basically everybody has to come to grips with before they do anything else. And then it's simply a matter of understanding that when this time comes, you're going to be looking at anywhere, depending on which part of the country that you're in, of $2,000 to $3,000, upwards of $8,000 to $10,000 to $12,000 a month in additional expenses to have someone care for you. And depending on whether you want to lie in a nursing home somewhere or be in your own home, to have additional money in place to do that, will make all the difference. It really comes down to, the resources that you have. And so what we've developed is ways of helping individuals create this asset inside their portfolio that may not grow every month or day like you hope your stock portfolio or a savings account does, But when the time comes, $100,000 in your portfolio will turn into an asset worth $400,000 and start paying, $8,000 a month in income to you. That type of thing. You don't have to have any more plan in writing. Everybody knows that's there, and they'll find it real fast. And so that's the kind of thing that we do is create those kind of strategies for people.
One of the things that I've done many times, because I carry my calculator with me wherever I go. In fact, I have my HP12C downloaded on my cell phone so that I can do calculations whenever I need to do calculations, and the car dealers hate that, by the way. They really hate it when I come in with my HP phone and I start doing calculations on the payments and all that stuff and present values, and they go, oh my gosh, let me call my sales manager. My wife gets mad at me. I said this the other day. My wife will not go shopping for a car with me because she says, you're just a butt. I had a friend
early on in my career, a good fraternity brother friend. I went shopping with him for a car, and the car dealer, the salesman, just got all over me and said, and he actually said, hey, you're screwing up my sale here. I said, I'm not concerned about your sale.
Funny. But one of the things I'm writing about in the most recent book that I am constructing, which is darn near finished, it is calculating the internal rate of return at a certain point. Not the internal rate of return, but it's the internal rate of return at a point in time in the future, whether it be retirement, to the end of retirement, or to a healthcare situation. And when we talk about healthcare and post-retirement healthcare and long-term care, one of the things you have to keep in mind is what is the actual cost to you from point A, when you start funding for it, to point B, when you actually use the money. Then how much of that money do you use? Working it backwards, what was that investment worth? Capiche?
Yeah, in fact, we do that as well in our planning, and show people how it doesn't really matter what you have halfway through the time period. What matters is what you have when it's time to spend it.
Right.
And and of course, in these areas where you're talking about, whether you're talking about income planning for retirement or healthcare planning for retirement, very honestly, when you put the insurance company products in the mix and start comparing it with other things you can do, there's no comparison. I mean, that's their business. And if people would get it out of their heads that if they have to buy an insurance policy of some sort or use any kind of an insurance product, that's not a good thing, they'd be a lot better off.
Gene Pastula, certified financial planner. We'll have him stick around because I've got to go into his pearls of wisdom. He's got 10 of them. I don't know if I get to all 10, but he has written.
If you read them fast.
No, because I want you to respond to certain ones.
Okay.
Gene Pastula from SafeMoneyMonitor.com. Check him out online. And when we come back, he's going to explain how a linked benefits plan could be the solution for many of these issues. So don't go away. If you have a question for Gene, just call him, 844-RAY-SHOW, or go to SafeMoneyMonitor.com, shoot him an email, and he'll shoot you back. I shouldn't have said that. He's not going to shoot anybody now, but he'll get right back to you. SafeMoneyMonitor.com. And if you want a copy of my book, text Ray to 88202. It's all free. We'll be back. Back to Gene Pastula, certified financial planner, as we talk about post-retirement health care needs, the number 2 concern, at least from an expense standpoint, of any concern for retirees. And for a lot of people, it's number 1 because they don't have housing expenses to speak of, because they already have a free and clear home. So it's got to rank way up there, especially in light of the fact that so many of us are unprepared for what Fidelity tells us will be a $220,000 cost just for the healthcare part. And that doesn't include the long-term care part. Gene, welcome back to the program.
Thank you.
You wrote the other day, top 10 reasons your clients would like to have a linked benefit strategy in their portfolio. You obviously wrote this to financial advisors all around the country. You deal with thousands of them. The question number one is, or the comment, is they want to keep their money in their estate so they can pass it on to their children. This one's very high up on the list for me, except I would add grandchildren, because when you get to our age, you've got grandkids, right?
Yes,
How many do you have?
Two.
Two? What are you waiting for? I guess you can't do much about it. But
Two's all I'm going to have.
you start thinking about their financial future and the fact that you worked for 40, 50 years to create a net worth. You don't want it to go up in smoke, because it's going to cost you $120,000 a year for care. And who knows, it could be care for 2, 3, 4, 5 years. There's $500,000 just like that.
Yeah, your son or daughter doesn't get a kick out of writing checks for $6,000 or $8,000 a month of their money, because you have not prepared for this.
And we talked about this a couple of weeks ago. The filial laws are pretty much in 30 some odd states say they can actually go after the kids' own money. It's not enforced in every state, but it makes you think about what the government's mentality is, because they don't want indigent people that the government has to pay for. They would rather go after your kids' money than put you in a facility. I don't know if that's going to happen, but there have been court cases where they've gone after the kids' own personal assets, not just the parents' money.
Yeah, all the Medicaid laws and what have you is basically set up so that the state provides the money if you're indigent, if you have no money, but then whatever assets you have after you pass is attachable by the states, and the filial, thank you, laws take it one step further and say, and the family is also responsible.
So leaving some kind of an estate to the kids is one reason to leave a linked benefits plan. So what is a linked benefits plan?
Linked benefits plan is fundamentally a life insurance policy that will pay its proceeds to the insured to pay long-term care bills. And if you think anything about life insurance, you know that what life insurance does is it takes a relatively small amount of money in the form of either annual premiums or one lump sum transfer, and leverages up into a very, very large amount of money at the time of death. That's what it's designed to do immediately. In other words, whether that death happens tomorrow or 20 years from now. And then in some cases we added even additional benefits for long-term care, so that you can leverage a lump sum, say $100,000, into $500,000 if you need long-term care. And if you don't, then the kids will get your $100,000 plus some insurance, maybe $150,000, $175,000. And you can do that with annual deposits as well. So that's the idea here, is to create this. Take one little small part of your overall financial portfolio and create such a huge amount of money out of it at the time you need it, if long-term care. And then that protects the rest of the number one issue on the list of protecting the assets for the grandchildren and the children.
So the nerd in me says, okay, what's my internal rate of return upon use of the money? And I would look at it two ways. What's the internal rate of return upon death if I never need any kind of long-term care? But since there's about a 70% chance I will, or my wife will, and that's obviously growing with life expectancies extending. So what is my internal rate of return from the time that I invest my money, in quotes, to the time that I get a return on that investment in terms of accelerating that $500,000 over X number of years? And that internal rate of return can be quite substantial depending on when the malady occurs and for how long. So here's my take on that. I'm going to bet on the fact that health science takes us longer and longer, extends our life expectancy. So my internal rate of return could be fairly darn good and it's all tax-free.
Yeah, the interesting thing is here's one time when you want that internal rate of return to be as small as possible, because the longer you live healthily and not use those benefits or not die and pass them on, the longer that happens, of course, then the less rate of return. I mean, if you want a high rate of return, either die or go into a nursing situation very early. Then you're looking at rates of returns of hundreds of percent. On average, typically age 85 we use as a benchmark. The rate of return on these contracts to the amount of money that's available is upwards of 7.5% to 8.5%, and that's tax-free. So in other words, you'd have to invest the same amount of money at 8%, let's say, without any taxes, and make sure that you lasted till your age 85 before you need it, to get the same equivalent of the amount of money that you'd have tomorrow simply by moving that money. And of course, you can get the money back anytime, so you're not really committing it forever without any chance of getting it back. It's an awesome approach, and obviously it's getting really, really popular. I'm literally finding myself, delaying getting back to people, or not being able to keep up with the amount of interest and demand that we have for these things, because it's really tough, But
well, could you use another?
Obviously, if they call me,
could you use another employee? Because I could use some spare change. I know that you only pay minimum wage, but I could certainly use.
Well, we could work something out. Yeah,
okay,
sure.
Good.
We can get some.
844 Ray Show. Gene Pastula, certified financial planner. Gene, you said something that resonates with me, because all the years that I did this, and I've been retired for a few years now, but I spent a lot of years getting jelly on the sleeves, sitting across the kitchen table with individuals.
Jelly on the sleeves.
Well, you're sitting around, they just had breakfast, and you got your jelly on your sleeve.
You get there early, don't you?
Well, I unlike some people I know, actually worked for a living. But in the very short amount of time that we have left, you mentioned something that's critical, and that is the fact that you can get your money back. Typically, when people think of a life insurance policy, they say, it's spent money. If I decide to change my mind 3, 4, 5 years from now, that money is gone, all these loads and expenses. This plan doesn't work like that. Give me 30 seconds worth.
Yeah, well, what we've done is in the forms that we use, where you simply just transfer a bank account or something like that into it, we've set it up so that it's in some cases just as liquid as a bank account. Other cases, there's a year or two of a reduced amount, a little bit, 5% or whatever, to take it out. But the idea is that when you put this money in here, it's just as liquid as you have in a bank account or anywhere else. So the idea isn't to spend the money. The idea is to just reposition the money into an insurance contract, and then utilize the rate of return that we get inside that to leverage it and make it. It's a lot more clear. If they call me or go online and request, I'll send them an executive summary that walks you through step by step by step through this.
And all you need to do is go to safemoneymonitor.com. That way Gene will have your email address, and he can email it right back to you. No cost, no obligation, none of that stuff. He's a super rich guy, so he doesn't need the business. Safemoneymonitor.com. Get the executive summary. This is something you're going to want to explore one way or the other for post-retirement health care needs. And the money, as Gene said, is liquid. If you don't like him in a couple of years, you just say, send me my money back, and the insurance company is contractually obligated to give you a 100% return of your principal contribution.